Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Also, Rob, we at the IC try to aggregate as much as we can. So we have the FX Options Weekly Outlook produced by Jason Ayers. We have trading alerts, webinars. I've written a lot of articles. And then the newest thing we have, which I think is really cool, is the widget. So you can actually download the widget to your desktop, and you can you have an aggregation of the 6 pairs. And then if you click on that, then it takes you to the options chains. It's really, really cool. You can get all that at the ISC site. Let me see if we take one or two more questions.
Yeah, I'm happy to answer. I'm happy to answer anybody's questions. Absolutely.
Ted wants to know, why would I give up leverage of the spot market for an option which has minimal leverage? Could you just, I think you took, you answered this very, very eloquently a couple of times, but can you do that again? Spot versus advantages, disadvantages?
Yeah, you know, that is a marvelous question, and let me repeat. I'm not encouraging anybody to give up anything that works for them already. I'm encouraging people to think about managing risk. And there are enough people in the world, just to preface everything I'm about to say, there are enough people in the world that are going to sell you something on the claim that it's going to make you $1 billion. The only thing I'm selling today is peace of mind, if I'm selling anything at all. I'm just here to tell you that management of your risk is more important than leverage or how much money. There is nothing more important than the preservation of the trading capital. If you look no further than Jesse Livermore for examples of that. Number two, the compounding of gains, whether realized in equities, options, spot, or anything else, the compounding of gains over time is the greatest invention in the history of the financial universe. But I have met very few traders in my life that were responsible enough or controlled their impulses enough to make money in any market, whether it's leveraged or not highly leveraged. Leverage matters less than your mental ability to stay focused and responsible. On top of that, to answer your question at the very end, do you want to trade a product with a counterparty that is guaranteed, or do you want to trade a financial product with a counterparty that is not guaranteed? Do you want to, in the bigger picture, another aspect of risk just isn't the stop loss. It's also counterparty risk and exchange-related risk. It's clearing risk. And if you have seen anything in the last year, you have seen that otherwise apparently stable financial institutions across the globe have run into problems because of counterparty risk. If there has ever been a reason to involve or educate ourselves about products that are exchange-related or exchange-cleared, the time is really now, and there still aren't enough people that understand that. So it's not meant as a criticism. I think leverage is fantastic. I love leverage. I think leverage can work for or against a trader, but leverage doesn't matter to me as much as the minimization of risk. I want to retain my trading capital, and I want to be able to put it to work for myself in the long term, not just necessarily in the short term, and I'm not making any accusations about somebody's mentality. So anything else, Steve?
I do see one other from Ed. Ed is a frequent attendee, and he loves the use of correlation. He's always looking at his question is, Rob, have you generally found a correlation, positive or negative, between the movement of the euro, say gold, oil, change in interest rates? Although I know he's asked that question to me before, so I figure I'll just pose that to you.
Yeah, you know, it might be the subject of a future webinar at some point, but Ed, I'm frankly ridiculously interested in correlations, and I run correlations in Microsoft Excel as well as in JUMP. It's a statistical program built by SAS, by SAS. I actually am fascinated by correlations, and I've done correlation studies between the euro and gold. I've done correlation studies between the euro and oil, as a matter of fact, which most people don't look at, or mainly they're focused on oil and the Canadian dollar. But it would take me, if I told you right now that I think one is really highly correlated to the other, and I didn't sit and explain myself or show some charts, I think I might be doing everybody a disservice because I'd be making some kind of blanket statement. I'm obsessed by that kind of analysis. Absolutely, yes. So there are correlations in particular been interested lately between the correlation between the euro and oil and how options prices on both are correlated or not very highly correlated at times. And when they get out of whack, the process of sort of trading back to some point of equilibrium, which, as you can imagine, is like my life's fascination.
Here's the one from me, Rob. So Yelling wants to know the difference between index options, index futures options. I really can't get into like the differences between the different products because that would take hours to spend on what they are. But this product here is basically like an index option. It's cash settled, European style. There are options on futures or that we're not trading that. We think that's a little bit more complicated. You always want to understand what you're trading. But as Rob said, BPX, it's just cash settled. It's as simple as looking at what the U.S. dollar is worth relative to the British pound at any time. And you could trade an option. The options, of course, when you buy them, you would pay for them in total, in 100% the next day. So I guess any more than that, we'd have to spend a lot more time on. I hope that helps. Harry has a question. Is there a VIX-related product that trades the FX currency market? No, we're working on that.
Are you really? Are you really? That's fascinating. Oh, that's awesome.
We'd have something like that. So we're working on that. But right now, Harry, all I can say is look at the implied vols. I'm really very interested in implied volatility since I traded options my whole career. And noticing that the U.S. dollar against the Australian, we started out at, let's say, 9 vol. Last November, you can check it out, vol went to about 45, which is an absurdity. It's another way, like Rob looks at Main Street versus the suburbs, and I sort of look at that also when I'm looking at an implied vol. So in November, I thought maybe the market was just getting too berserk, at least in the FX market when I saw the AUX trading at 45 vol. Subsequently, it's actually been cut in half to about 20. But what does it mean for direction? Not really sure. But again, you probably want to draw your own conclusions on that. Anything you want to add there, Rob?
I think that we didn't really get into it today, but I think some of the second and third best trading opportunities, in 2009 will be related to the Australian dollar, and I have 1,000 opinions about the Australian economy and whatever, but basically, I think if you're not sort of exposed or have some exposure to that side of the world or whatever, there's some fascinating things that are going to go on, and so I definitely take a look at it, study it. The Australian economy is pretty small. You can actually have a running conversation with somebody that works at the Australian Reserve Bank. Try to call the Fed up and ask them about policy and research. So yeah, absolutely. The Australian dollar is chock full of opportunities, and I think that one of the stories of 2009 might particularly be that the Australian dollar as well recovers a great deal of ground that it lost during the last few months.
Very, very interesting. Rob Zaire wants to know, I think he's got it backwards, because he says, is Rob long BPX? I think you're actually saying that you think that BPX is going to actually come back to Main Street, and it would obviously come down a bit, correct?
Yeah, I'm short BPX, which means I'm bullish British pound.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.